Property investing is often seen as a stable and lucrative way to build wealth. Over time, it has earned a reputation for being a relatively safe investment, especially compared to more volatile markets like stocks. But like any form of investing, property investing comes with its own set of risks. So while it's not inherently risky in the way speculative investments might be, it certainly carries risks that must be managed carefully. In investment, risk refers to the possibility of losing money or not achieving the expected returns. In property investing, risk comes in several forms, but they are often paired with potential rewards. For example, real estate can generate income through rent, and properties can appreciate in value over time, offering both immediate and long-term financial benefits. However, the potential for reward is balanced by the following risks. The market risk. Economic downturns, changes in interest rates, or oversupply in the housing market can cause property values to drop. Liquidity risks. Real estate is an illiquid asset. Selling a property quickly is not always possible, particularly in a down market. Then there's tenant risks. Renting out properties comes with the risks of tenants defaulting on rent payments, damaging your property, or vacating unexpectedly. And there's also lending risk. Financing your property investments, whether through traditional mortgages or more specialized loans, introduces risks that can amplify your financial obligations. The lending risks tend to be mortgages and bridge loans. Financing is a critical element of property investing, but it also introduces a significant amount of risk, especially if cash flow isn't as steady as expected. Let's have a look at mortgages. So the monthly burden for many property investors, mortgages are the primary way to fund investments. While they allow you to purchase properties you might not be able to afford up front, they come with fixed or variable monthly payments that must be made regardless of whether your property is occupied or not. If you're relying on rental income to cover your mortgage payments, the risk becomes apparent if your property sits vacant for a few months. Vacancy periods can be especially tough in areas with high turnover or during economic slowdowns. If you don't have significant emergency funds or alternative income, your mortgage payments, property taxes, and maintenance costs can quickly become a financial burden. And then there's bridging loans. Bridging loans are usually used for quick access to finance when you need a quick purchase, typically for a property that needs renovating. While they can be useful for fast turnaround investments, bridging loans also carry significant risks due to their short repayment terms, usually within 6 to 12 months, and they come with high interest rates. The primary risk with bridge loans comes when the loan term is coming to an end. If you haven't successfully sold or refinanced a property by the time the loan period expires, you could find yourself facing financial difficulty. Unlike traditional mortgages, which are spread out over many years, bridge loans require rapid repayment. If you're unable to repay the loan from the proceeds of a sale or a new mortgage, you may be forced to take out another loan, extend the terms, which usually comes at a higher cost, or face financial penalties. This situation can quickly spiral if market conditions are unfavorable or if the property doesn't sell or rent at the price you anticipated. Without the necessary cash flow or solid exit strategy, bridge loans can create significant financial stress. To navigate these risks successfully, knowledge and experience are crucial. Experienced investors know that understanding the market, the local area, and the financial ins and outs of property investments is key to minimizing risks. Investors who are well versed in market cycles and who know how to assess properties in terms of location, condition, and long-term potential are better equipped to avoid costly mistakes. Additionally, having a solid grasp of financing options, whether you're considering traditional loans, bridging finance, or other alternatives, helps you make more of an informed, strategic decision. However, I wouldn't recommend that you get into property investing without some prior knowledge and education. You'd be making a considerable financial commitment, no matter how big or small, and it comes with the risks I'm outlining in this video. This is why I've put together a free property investing training resource, which you can access through the link below in the description. Educating yourself first is the smartest way to mitigate those risks and set yourself up for success. But knowledge alone isn't enough. Experience is a powerful teacher in property investing. Seasoned investors often have an intuitive sense of when to buy or sell, how to manage cash flow, and when to take calculated risks. The strategy you choose plays a massive role in how much risk you're exposed to. Different strategies come with different risk profiles and rewards. Common strategies may include buy and hold. This strategy is typically lower risk. The idea is to purchase a property, rent it out, and hold it for the long term as it appreciates in value. However, the risk comes from the potential of vacancies, rent defaults, and market fluctuations. If rental income isn't consistent, you still need to cover your mortgage payments and maintenance costs. Buying properties, renovating them, and selling them for a profit can be highly rewarding, but this strategy is riskier. Property values can fluctuate, renovation costs may exceed estimates, or it may take longer to sell than anticipated. If the market dips during your project, you could be left with significant losses. Then there's property development, whether it's converting an old building or constructing new ones. These can yield high returns, but it comes with a high risk involving large capital outlays, potential construction delays, and uncertain market conditions. And then we have commercial property. Investing in commercial properties like offices, retail spaces, and so on can offer high returns, but carries risks such as longer vacancy periods, higher initial costs, and market volatility. When managing risk in property investing, there are several important conditions that can help you minimize your exposure to financial challenges. Firstly, if you're new to property investing, it's wise to start with more manageable investments. Consider smaller residential units or properties in an up-and-coming area that don't require heavy capital. This gives you the chance to gain experience while limiting the potential for large losses at the outset of your investment efforts. Another effective strategy is to build a well-balanced portfolio. Rather than focusing on one type of property or location, it can be beneficial to have a mix of investments that help mitigate the risk of downturn in a single market. A diversified approach offers more stability, but doesn't necessarily mean spreading yourself thin across too many options. It's also essential to have a solid exit strategy in place. Whether you're looking to sell, refinance, or convert the property into a long-term rental, knowing how you plan to exit the investment will help you make a better decision and avoid being caught in difficult financial situations. Having a well thought out exit plan will provide clarity and help you manage any uncertainty down the line. Additionally, always maintain a financial cushion. Property investments come with ongoing costs, mortgages, maintenance, taxes, and insurance. It's essential to have an emergency fund set aside to cover unexpected expenses, vacancies, or repairs. This will help ensure your investments don't strain your finances if things don't go according to plan. Lastly, don't hesitate to seek advice from experienced property professionals. Reach out to brokers, estate agents, accountants, and mentors who have practical experience in the property market. These individuals can offer valuable insights, provide you with advice tailored to your specific situation, and help you avoid costly mistakes that less experienced investors often make. So to conclude, property investing does indeed carry risks, but it's not necessarily dangerous if approached with the right knowledge and planning. Like any investment, these risks can be effectively managed, especially if you focus on solid market research, make careful decisions about where and what you want to invest in, understand your financing options, and maintain the flexibility to adapt when necessary. While eliminating risk completely is impossible, making informed choices, learning from experience, and having a well-structured strategy can significantly lower your risk. This approach helps you take advantage of the opportunities property investing has to offer. And as I mentioned, I have put together a free property investing training course which will give you more insights into creating wealth through property. I've put a link down below in the description for you to get started immediately. And as always, my friend, thank you for watching. I appreciate you being a subscriber, and I'll see you again on the next one.